But in terms of how or why I think we'll look at it, I'm standing here as a buyer of these bonds. I will buy some, that's all there is to it. I've already made that decision. Now, that's not because it's a wonderful instrument that stands in the marketplace alongside any other alternative investment and makes a lot of sense to go into my DIY fund or whatever entity I want to put it in. It has more to do with the fact that I'm involved in UPIN and have been since it started. So I thought I'd just touch on the reasons why I've already made that decision, because it doesn't mean that I'm just a standard investor who knows nothing about these things and just think this might be a good idea. I'm already committed to it. And why is that? I think it was touched on by Sally earlier. You know, my first interaction with UPIN was about 10 years ago, speaking to a young mother in tears who was just explaining to me. I said, "Why are you here?" And she said, "Because basically my mother and father abused me, and so was my mother and father abused by my grandparents, and it's starting to happen in my family. I don't want my kids to go through this." So if any of you are out there marketing products like this and you get that response, well, why should we help children go back to bad families? It's not bad families, it's families who are struggling to try and come to terms with often a long intergenerational situation which has brought about the situation they're in now. They don't want it either, right? So what UPIN is about, yes, it's about child safety, but it's primarily about good parenting. And people make a big commitment to come up to 4 days a week for up to 2 years to try and get that right. They make the commitment, and UPIN supplies the support that allows them to actually carry through on that. So without drawing too much on cliches, you know, they're not asking for a handout, they're asking for a hand up. If you help us, I'll give this my best shot. And that's why we get the results that Sally talked about. We end up restoring a lot of families to quite a functional state with a great deal of dignity in it to provide a safe environment where those children can return, and we get a better result. And that's what those families want, that's what the community wants. That's why I committed to working with UPIN a long time ago. Second reason why I will be buying a bond, because twice a year I've been writing a cheque for UPIN for 10 years and I never get any money back. So if someone's going to come along and say, "Why don't you write us just a slightly bigger cheque and we'll give you some interest twice a year and we'll give you your money back in 6 or 7 years," that's not a bad result for me. That may not be something that someone will immediately respond to, but for me, it's because of what I've gone through and where I'm at. But I, as an individual in that sense, is really not very different to a foundation, because it costs about, I'll just keep this arithmetic really simple, and also, of course, we're bound by confidentiality, but the principle, and Graham referred to the spreadsheet I showed him 2 years ago when he came out to my place. It was a very little spreadsheet, you know, just 20 lines long and about 12 lines across, just saying that, you know, we spend $500,000 a year running a UPIN. And yet here's a number from that time from McKinsey, and it was roughly $50,000 a year, the cost of maintaining a child in out-of-home care. And we were, out of that $500,000 UPIN program, putting 10 kids back into families very safely. 10 times 50, $500,000. In other words, we were saving the government every year the exact amount it cost us to run the UPIN. So if you run the maths, you can just see what happens. Second year, you're still saving $500,000, and there's another $500,000. So it's just an arithmetic line that goes up. The cost of UPIN stays here, it goes up inflation weighted, but this amount here grows hugely, and you end up with often a 3-figure sum of millions of dollars. And that's not cumulative, that's every year it's growing. So you can see there, while we pay for the actual program and we pay back the bond. So there's a lot more to it, obviously, and a lot of you have talked about it, but that's the basic principle. That was the spreadsheet I gave Graham that day 2 years ago. He came back 2 months later and sent me a spreadsheet which was 400 lines deep, about 40 lines across, and said, "What do you think?" And I said, "Well, it's really big." But it's testimony to the amount of stress testing that's gone into this project. This has been going for 2 years, and I've seen that's just worksheet 1. You know, that's before the various iterations and whatever. And thankfully, I was away overseas most of the time that we had to deal with this with Treasury, so I didn't have to look at it. But there's a lot of work. So this is not something where someone thought, "Oh, good idea, let's do it." There's a lot. That's why it's taking so long. It's the first one, and it's hard to do, and everyone wants to get it. No one wants to get this wrong. You know, the government doesn't want to get it wrong. I mean, we all know bad politics. We don't want to get it wrong because it will affect our clients. That woman I just spoke about, and thousands like her. I don't want to get it wrong. I don't lose all my money. So we're all in this together. The stakeholders are actually bound in a lot of ways to make this work. And that means also that the government's aware that we can't set the bar too high, that this investment bond has got to jump over, because we don't want to jeopardise the integrity of our program by saying, oh, we get a few more kids out of home care. We don't want that. We want to continue to be able to say, oh, that's a great result. That family is ready. And by the way, it's not our call. It's the Children's Court, Department of Child Services and so on. We're not the ones who make the decision. So again, it's another reason why I just want to be involved in what happens here. If we ask, who else is going to buy? Well, obviously, to the extent that I'm just a small example of a big foundation, just a private individual, but who's going to buy it? I mean, I mentioned the philanthropy conference a while back. Where's the money coming from? Why doesn't the government do it? Why doesn't the government just buy all these bonds? And the simple fact is there's no money. We've all noticed this. It doesn't matter whether you're the Greek government or the Icelandic government or whoever you're in debt. There is no money out there at the moment, and it's not a political thing. It doesn't matter whether it's Gillard and Abbott. Half the campaign is about how do we lower the deficit. Ditto Romney, Obama. Earlier this year, the Chancellor of the Exchequer in the UK tried to introduce an initiative which would eliminate tax breaks for wealthy investors who were making philanthropic donations. And by the way, the Blair government had looked at the same thing coming from a different perspective. But the argument being a social justice argument, why should we give up 45% of this rich person's income and have to get it back from these people who are only paying 25%? Now, you can see the logic. That's probably not why they're doing it. They want the roughly £4 billion per year that the UK government doesn't get because it's deducted from philanthropic tax deductions on philanthropic contributions. So there's no money. There's no money. Both sides of politics, we're facing deficit financing. We're probably in that hole for the rest of this decade. So there's no money over there, and even philanthropic endowments have been impacted by the GFC as well. So there's no money. So where can we go? And I think Craig pointed this out with his map of how much is parked in the capital markets in the form of bonds. That's where the money is, and that's what this social bond really is addressing. So there's no money there. We've been trying to get sustainable funding for Nepean for years. We just can't get it. This is a sustainable model because of the charts I was trying to make with my hands there. So that means that it introduces the notion of sustainable philanthropy. So that if you're making a grant, if we go to you and say, we have $100,000 because we're setting up a new pin and it goes brilliantly and we restore families and everyone's so happy, and then we come back and say, great, can we have another 100? And we come back next year and say, another 100? So what if we went to you and you said, can you grant us 100, we'll be back in 7 years, you've got your money back, we'll pop in twice a year and give you a cheque for interest. It's a totally different investment decision. Now, if you ran that right to its longer term outcome, it does raise the question of shifting that decision from a grant decision to who's running your endowment. Now, there's a lot of issues there. The people running your endowment really are, in terms of fiduciary responsibility, are meant to be optimising that result. So straight away there's a conflict. It might be mission aligned that you're going to help a Nepean, but does it meet the criteria that you have to adhere to because you're running people's money? I think that can probably happen over time as we get more of these bonds in the marketplace. They become an asset class in their own right. Whether they ever get rated on it, I don't know. Maybe rating agencies can come up with a category by which they can rate them so that the blended outcome is something that can be accommodated. But eventually I suspect it will move quite a few years out into the investment side of your organisations. And that is great because that means we won't ask you $100,000 at all. We just say give it to someone else because you're holding our bonds. So that's another reason why I'm supporting it. I actually conceptually think this is a great move. And I come from an investment banking background, and so I'm probably more aligned with things which are based on market forces. But at the start, this is not going to be simply market forces. And as we've heard with the Peterborough bond, I think around about half of the money came from foundations. It came from the grant side, not from the investment side. So what can you do? Well, you can buy them, just like me. But there are a lot of foundations out there who are much more innovative. I would expect over time a lot of foundations would look at possibly underwriting them, and frankly the way the Westpac CBA model is, pretty much BenSock's kind of underwriting a part of it. Underwriting just simply means $10 million bonds, I'll take them all and then we'll sell them, and If you can sell 9 million, I'm left with 1. That's just the principle, right? But there's also underwriting in the Peterborough bond, in the sense that the Lotteries Board actually made up the shortfall for the Ministry of Finance. They didn't have enough money to underwrite the outcome side, and so the Lotteries Board simply helped support that. And they may get a return on that, I don't know. It depends on how the thing goes. But it was a decision. It wasn't a decision just to buy. It was also a decision to underwrite part of the mechanism. And the tranching process that Westpac were talking about, same thing. It's simply dividing it up into different marketplaces. Different people can buy different parts of it. Certain parts could be suitable to a blended outcome where a philanthropic organisation is happy to take a higher risk because it's a mission-aligned product. And they're happy to make the grant to it because that's what they do anyhow. So in terms of people who buy them, I suspect at the beginning we will be very much around people looking at the blended return, not simply the standalone financial instrument. I would think eventually that's the end game. The end game is really that we end up with something that, you know, some guy walking out there I can see now would say, oh, that's a good idea. You know, I think I'll buy some of those. We're not there yet. We're probably not there yet for managed funds to buy them, simply because, you know, rating, all of the things that have been mentioned, ratings and the risk and there's no liquidity. You know, I don't know yet, I might be wrong, but I don't think any bond in issue, there aren't many of them, have actually changed hands yet. But sooner or later someone's going to want to sell one and someone's going to want to buy it, so sooner or later we'll get a market. And then gradually over time that can become a secondary market where anyone's like, oh, I want a social bond, and you'll just go into a market and buy one. That's a long, long way away. It's got to be sorted by people who are prepared to support the concept and believe in the return as much as possible at the very start. Overall, I've told you why I'm a buyer. I actually have no difficulty with this concept, and I do believe there's a return there. I believe in what Newpin does, so it's kind of an easy decision for me. I see our results, I know what we do, I know what our outcomes are. But I don't think anyone in the room having a close look at the two we've talked about today would come away and not say, hey, that's a fair risk. You know, that is a fair return. I don't know what returns are going to be like. They seem to be between 5 and 15%. And they could be in different numbers. I think the recidivist bond in New York at the moment, which was taken up by Goldman Sachs of all people, it is topped and tailed. There's a downside cap. Goldman can't lose more than 2-something million, but they also can't make more than 2-something million. But that's again because a philanthropic organisation, in this case, like Michael Bloomberg's foundation, said we will underwrite the downside, and if we get up on the upside, we'll cover it there. So they locked it in, and suddenly the coupon they have to pay is down to 5% because the Bloomberg Foundation was able to underwrite those extremes. So there's a lot of ways this is going to come together, but the basic principle of what I started with, that really the outcomes that we produce generate a savings for government, which is actually quite staggering over years. And by the way, once the bond's paid back, it just keeps going. It's perpetual, or it could be perpetual, and it's sustainable. And getting sustainable funding is what we've been trying to do with Newpin, frankly, for years. And it's odd, isn't it, that when this idea has come along, we've grabbed it and we're trying to go with it, but it also opens the door to some form of sustainable philanthropy as well. Thank you for your time.